Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the Abernathy Group Family Office December 2024 First Friday meeting. Today's presentation is titled 2025 Economy, Valuation, Geopolitics. What's next? In our First Friday meeting today, we're going to do our best to look forward and envision what is likely to be our future in each category. Our goal is to help you create reasonable and intelligent expectations for what lies ahead. Today, our prepared comments will be recorded, as other families who are unable to attend have asked us for the recording. Our comments today will be approximately 20 minutes long, leaving us plenty of time to take questions from participants. If questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand at the end of the prepared remarks by clicking on the React icon at the bottom of your screen and selecting Raise Hand. I wanted to remind you that we really do enjoy your questions, and we will do our best to get to your questions at the end of our prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Matthew Daly and Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen Abernathy, and this is the December 2024 First Friday meeting for the Abernathy Group family office members. Just a quick note, this is our 25th monthly meeting, and all of the meetings recordings are available on our YouTube channel and on our website. And by the way, if you haven't been to our website lately, as I said last month, please consider visiting it. There's a wealth of information and some clever estate planning ideas you might consider, as it's likely the future in the United States is destined to try not to allow the U.S. citizens to pass along the amount of assets to the beneficiaries that we'd like to pass them on to, because we have a little tax problem. I'm sure all of you know by now. So I bring this up because for many, the exorbitant taxes on their hard-earned assets accumulated over a lifetime, it's just going to be a bitter pill to swallow when you find out that these assets, once they exceed a threshold, will be taxed at historically somewhere in the 50 to 75% range. And we want to ensure that each family is entirely able to pass along as much of their hard-earned savings as they desire to those that they choose to receive those assets. Also, just as a short note also, we recently started another company focused on reducing the costs of offering employees a corporate 401k plan, while offering each employee the amount of education they need to make intelligent decisions about their future. We feel like employers build a 401k plan and they think their job is over, and most of the employees they're lost. They don't have any idea about how to take care of themselves. So the bottom line is we've built another firm just for educational purposes, and our goal is to turn a company's 401k plan from a cost center that just is bereft, it's just full of problems going forward, into a significant tool when recruiting valuable employees and retaining current employees. So if you have a few minutes and if you have a retirement plan, give me a call or stop by the website and read some of the research papers we published recently. We had a bunch of things published and probably had 10 or 15 articles published recently that they're helpful. Anyway, as Marissa said, this month we want to spend our time together by taking a look at several of the most important variables which determine each family's investment allocation. So we're going to start off by taking a shot at understanding what investors might expect from the new administration entering the White House in January. This was the most often asked question, and I think it's naturally for a good reason. New administrations tend to make lots of promises, and these promises tend to engender incredibly high expectations. Over time, reality sets in, and the realization that most of the promises are unattainable or just were campaign promises. I'm sorry to say that about our electorate, but it just happens. So, and again, I want to make sure that you understand. I'm just trying to be analytical about these topics. I'm not trying to be a glass half empty researcher. It's just that over the last 200 years, we've seen this movie before. And despite the best intentions of each new administration and each incumbent administration, the results tend to be significantly less impactful than the expectations that they bring on. However, with that said, let's bring in Matthew Daly to give us a few prepared remarks, which will hopefully help us create reasonable expectations about the future for our United States, and I'm sure that the administration entering is going to try their best to carry out what they've said. But let's see from Matt. Matt, let me offer or start this out, and each of you that's attending, if you have attendant questions, please type them in below. We started this out as making this sort of a town hall, and we want to hear from you, and I do hear from many people during the week. Matt, so let me start this out by saying, or by asking, given the really, I think I would characterize it as really good intentions of the incoming administration. Would you do your best to give us what you think is a realistic outlook on what is obtainable and what is unlikely to be achieved during the next 4 years?
Sure. Thanks, Stephen. So I think that was a good lead in, which is things are talked about, but at the end of the day, there's all sorts of unforeseen challenges in getting these things across the finish line. Sentiments change, world events can change. So I think putting it to start, as I think we've said pretty much on every First Friday meeting for the past 4 or 5 months, that history shows a new presidential administration has little to no effect on the overall health and trend of the economy. I don't think we're changing that viewpoint. However, I think it is important to acknowledge that there are certain unusual aspects of the incoming administration. One, it's a president that's been a president before, was out of office, and now is coming back in. In theory, there's some time for reflection there and some time for strategizing. I don't know if that's taking place or not, but certainly does seem like there's some, at least a pretty robust game plan coming in. Again, whether those things get over the finish line or not always remains to be seen. But I think the unusual aspects, you can identify some events and actions that could take place and discuss briefly what effects, consequences of those policies or actions could ultimately affect the markets or just stability or what have you. I think it's a fair statement that components of this new administration, the people involved or the people that have been put forth to be involved, again, that's another uncertainty with confirmations and all that. But policy projections, the policies that have been outlaid and the potential actions that have been proposed thus far, many of which could be considered unprecedented. We also have a fair amount of evidence from Trump's first term of what his actions or his behavior may be like. I think the overall approach regarding all aspects of the administration is to not be too reactive. Be patient and see how things shake out. I don't think it would be wise to take every announcement as something that is going to happen, and I don't think the effects overall will be as drastic potentially as the words. For example, we know that Trump likes to use threats of tariffs and threats of sanctions on the international stage as deterrents or as bargaining chips, the first kind of punch to see what happens and what we can get away with and what we can get out of a deal in particular. I think we can expect to see more of that. We've already seen a little bit of it since the election, but we can probably expect to see more of that in the next 4 years. The summation there is just, I think, reacting to an announcement or a threat to another country. Let's just see how it shakes out, because between that initial proclamation and what ultimately happens, typically is relatively different. If the people who have been nominated for cabinet and advisory positions are confirmed, then I think it's fair to say that significant changes, or at least significant proposed changes, are on the horizon. Americans have extremely low, if not historic low, trust in government. Large changes are often painful in the short term. I think some of the things like the Department of Government Efficiency, the mass firing or quitting of federal employees, while maybe a good thing in the long term, it will probably shake some things up in the immediate term. But if executed with the right ideas and intentions, again, they could provide long-term benefit. Regardless, the proposed changes will lead to either increased or decreased trusts, depending on how they're executed. I believe that it is likely that information will be released that's uncomfortable for certain government officials, agencies, private companies, or industries. For example, things related to COVID and the response, pharmaceutical industry, our military, industrial, and intelligence apparatus, the food and beverage industry, and the mingling of money in politics and government corruption and inefficiency. Some of those things may come to light. Again, that is maybe shocking and may cause short-term disturbances. But again, I think on the same theme, potentially having beneficial long-term effects. Virtually everything that was mentioned has the opportunity to do just that, cause short-term short-term volatility, cause the market to swing up or low, higher or lower on an announcement or on a data release or something like along those lines. But again, I think the theme here is patience and to see how things shake out. Because I think at least on the proposals, there's some opportunity for long-term benefit. And I think the degree of change which has been proposed could be likely to cause some short-term disturbances.
Matt, let me ask you a quick question. So, just your 2 cents. We all know that government's bloated. Over 60% of all job hirings over the course of the last 4 years have been government, which is actually terrible. It's just almost despicable. Bloating the government like this. My question is, if Vivek and Elon are able to cull a couple of $1 trillion out of our government spending, that sounds like it feels like that's about 2 million government employees. What happens economically if we have 2 million additional people out of jobs over the course of the next year or so? When is the Doge supposed to implode? Isn't that April or May this year?
July 4th, 2026, or
I'm sorry, my fault.
250-year anniversary.
Got it. Okay.
It's supposed to be disbanded on that date, so they've got time, but it's not. In government lenses, it's not a ton of time. Things tend to go slowly. So it is to private citizens and business people taking the axe to it. So maybe it's called the Department of Government Efficiency. We'll see how efficient they can do it. And I think similar to Trump's first term, I think he didn't fully understand how government works and how slowly and inefficient it is. Of course, that's the goal, is to change a little bit of that, but it's a big machine, and I don't want to be overly optimistic on how quickly it can change.
Okay. Marissa, can we stop real quickly and just check and see if there are any questions so far on Matt's commentary?
Yeah, so far, no questions have been submitted via chat, but if anyone does have a question, they're welcome to send one along anytime.
Got it. Okay. All right. Let's go on. Let's take the temperature of our U.S. economy and the fate of the economic trends to influence both I think both the short and the longer term performance of all of our investment portfolios. Let's just see how this kind of fits in. After we go over this, just the U.S. economy, we're going to spend some time on the valuation of publicly traded assets because the simple reason that current valuations determine long-term investment returns. You know, we're going to follow this discussion at the end with a short geopolitical landscape discussion, and because it's a we call it a fat tail event. These are fearsome events that could happen geopolitically, like wars and world wars, and now that we're so well stocked with armaments, we can destroy the world in a heartbeat. And we think that there are enough crazy characters around there we're worried that there are enough crazy characters around there to do that. First, as always, we want to discuss the data. So as data is combined with with historical experiences, it tends to become the foundation of future expectations. So we tend to focus our attention as analysts on leading indicators. We use these leading indicators as signals for what lies ahead, and they're not foolproof. Nothing is. We want to note that while, as I said, no signal is a guarantee of future outcomes, focusing on signals as opposed to focusing on noise will help create much more valuable expectations for what lies ahead. And the leading economic indicator index combines several of the most reliable variables which tend to lead economic activity. For instance, new applications for new building permits, new manufacturing orders, and the yield curve, which sort of describes the ability for US businesses to borrow money at realistic levels or not, as the yield curve inverts and short-term rates are more expensive than longer-term rates. Business historically has been suffocated because we're a debt-based economy. In short, the leading economic indicators are a reliable, yet they're not a guaranteed signal of our future economic activity. Let me show you what they look like today. So here's what the leading economic indicators are telling us now about our economy. This is through the first quarter of 2024, and it shows that our US economy is moving along well after being in the doldrums for well over a year of forecasting a recession. So most of you remember this portion and our fear of what was taking place, and we were below recession levels indicated by the LEI, or the leading economic indicators. They were telling us to expect a recession for the past 2 years or so, and it appears that the combination of the incredible amounts of stimulus pushed into our economy by or into our economic system by the administration in Washington and an always resilient US consumer, it feels like we may have avoided a recession in 2024. I just want to take a moment to show you guys, to show everyone on the call, that this is only the second time in the last 50 years that this indicator has signaled a recession, yet none arrived. As said, the leading economic indicators are really fine signals. They are for sure categorized as signals, not noise. But I want to take another look at the statistical data from another angle. And this is really from a clever analyst that we've been working with for years. His name is Eric Basmadian, and he's an intelligent and diligent economist. And his insights are almost always worth being aware of. So Eric put together a series of charts which show the time progression of each relevant indicator most economists watch. Okay, so let me give you a look at this real quickly. So the green bars indicate what the data told us 24 months ago. The yellow bars indicate the same data 18 months ago. The light blue bars indicate the same data 12 months ago. The red bars indicate the data 6 months ago. The dark blue bars indicate the data from September 2024. So what in summary, so the chart is showing you, or showing any researcher, a time varied progression of what's taking place in our economy over the last couple of years. And there's 4 groups of indicators that we need to pay attention to. On the left, you're going to find the leading economic indicators. You can read it on the screen. And these are indicators, as I said earlier, that show you what I guess I'd call them the variables that are sort of like, as we said earlier, purchasing managers indexes and building permits. These are things that may not come true, but that are indicative of future growth. The next chart over, or the next, I guess I would say second from the left, is the cyclical indicators, which show the economy as it's developing or just beginning to happen. And it's probably the most important variable outside of the leading indicators. And what I want to call your attention to is over on the far right side, that dark blue bar has now turned down. That's weird, and it's indicative of an economy that's giving us mixed signals, lots of mixed signals. The cyclical economy includes residential construction and manufacturing employment and basically current overall employment and current production numbers, among some other things. It's an important variable. The third bars from the left are the aggregate economy, and it gives us a similar data point as our GDP. And you can see that our GDP is still in the 1% to 2% area, and I wouldn't expect it to be any higher than that going forward. And the last section we call the lagging indicators. And the lagging indicators cull together all of the indicators like the services and consumption. So these are things that happen after business takes place. And it's really just an output of the aggregate data demand. So here's what I want to show you. The red indicator here, the red indicator here, as I pointed out earlier, it shows that there's weakness beginning in September of 2024. We don't know whether this weakness was the beginning of a downturn or whether it was a sort of a one-off event. Yet you can see that the trend over the last 24 months in both the cyclical indicator and in some of the other indicators has been showing how would I say this? I guess I would just say a weakening economy. That could very well be, and probably is, because the government or the Jay Powell, the Fed has been stamping on rates and cutting off some of the flow of free money into the system. Again, these indicators are sending us mixed signals. In aggregate, I want to make sure that I'm on the record as telling you that the U.S. economy tends to be in pretty good shape. However, as I said earlier, economic activity is slowing. There's no question about this. Yet, and no one knows whether it will slow to the level of tipping us into a recession. And that is an event that every member of the U.S. Is hoping to avoid. That's for sure. What are the current expectations that are already priced into the market today? I think this is the most interesting portion of what we have to talk about today. So what can we expect based on current prices of assets? And many of you will see, I think you'll see why we're positioned as we are in our portfolios. As I'd said, it's important for each of us to understand this, and the reason is because current prices, how would I say this, display base case expectations. The base case says if current expectations are realized, there will be no depreciation and there'll be no appreciation. The base case is it's here. So for the sake of this argument or this talk, we're going to say that the base case defines current expectations. So what are current expectations? And what do current expectations tell us about what's likely to come? So today, current prices say that we're expecting to increase earnings by 15% in 2025. If we increase earnings over 15%, the market is probably a little bit undervalued. And if we increase earnings less than 15% in 2025, the market is overvalued. Will this happen? We think it is highly unlikely, as earnings over the last 100 years have been growing at an average of just a little bit under 4% per year. So to expect 15% in 2025, after 2 years of 9 or 10% in earnings increases, I think it's incredibly optimistic, and it's sort of Wall Street's calling card to kind of sell you something that they probably don't believe in, but to sell it to you, to keep you involved in the game anyway. So we believe this is going to be a very difficult bar to cross. And we think that many of the springboards that were present over the course of the last 15 years or so, 0% interest rates, increasing leverage levels, all of these things are going away. The market is also expecting inflation to head towards 2%. I don't know whether it's going to get to 2% or not, and to stay at 2%. So that means no tariffs. That means that means that all of the historical situations where inflation exceeded 9% were, and by the way, the average time it took to get out of that was somewhere in that 8-year area. That means we will have done that in 3 or 4 years, which is half the time history tells us to expect. So current expectations are calling for inflation to come back down to 2% or nearly 2%. And we think that expectations are describing a perfect landing. And it's one that we all want to see happen. I just don't know whether it's likely to happen. To add fuel to the fire, here are the expectations built into current prices for the next 5+ years, almost 6 years. As you can see, current prices are expecting earnings to grow at over 7% per year all the way through 2030. They're pricing in no recession over the course of the next 5 to 6 years. And this is great. Yet it's just incredibly unrealistic. No recession over the next 6 years when Recessions tend to take place every 3 to 5 years, and we haven't really had one other than the COVID step down since the GFC, the Great Financial Crisis, and that was in 2009, 2008 or 9. So again, I'm not trying to be a negative analyst. It's just that when the assets are pricing everything for perfection, there's little to no upside left, and everything has to go right, or the downside is significant. Let me show you just a little piece of quick evidence to illustrate my point. This is a chart put together by our friends over at Zacks. This chart shows the progression of earnings estimates when they're first made, and as it progresses over the next several months to get to a level that's closer to reality. This is Wall Street laid bare. This is the way they do things. They tell you that everything is wonderful, and then they skinny it down and skinny it down and skinny it down over time. So, as all of you guys know, we're no fan of Wall Street. We believe they have and always they've had an incentive to tell you the best news possible and then let reality set in. And I don't trust Wall Street too much, and I don't believe you should either. Slide 15 shows you that not only are valuations expensive, leaving investors who own public equities little room for appreciation. It also shows you that speculation defined by owning securities on margin is or at record levels. It's, the reason I'm showing you this chart is that when highly priced assets are mixed with speculative leverage, outcomes become leveraged on both sides. So good results become great, and bad results become disastrous. And that's where we are right now. We're at almost record levels of debt. And as you know, valuations in public securities are at or near record levels. So, this chart shows you that valuations are not only expensive, they're leaving investors who own public equities little room for appreciation. And, speculation is, in my opinion, not very good for anybody. Let me go back to this slide I wanted to show you. Here's a slide courtesy of one of the most noble analysts in the financial community that I know. He lives in out in Oregon now. He retired years ago in favor of growing thousands of acres of trees. So he's a tree farmer now. In short, he doesn't have any bias. He doesn't try to sell anything. His website's free, and he's really smart and level-headed. Just about as level-headed as anybody I've ever met to date. And just looks at the numbers. The reason I'm saying all these things that are nice about him is that this chart sort of was put together by taking the current valuations of public securities at the beginning of Q4 2024. And as you all know, the market is even higher now. And he used the reversion to the mean to determine how stocks are likely to perform over the next 5, 7, 10, and 20 years if we revert to the mean. And we might not. We might stay overvalued for 20 years. Keep in mind that the returns on this chart are nominal returns. They are not, they include inflation. So what I'm saying is they're not real returns. And these are sort of best case returns. So this chart, and there are many others like it, create a realistic picture of what investors who invest in the stock market expecting appreciation from these levels should expect. And the reason people do this is called recency bias. The last 5 or 8 years have been terrific years. And memories are short. People don't think about history. They don't want to do the work to find out about history. But all I can tell you is history says that these things are expensive. Your expectations should be modest. And for most of us on this call who don't want to go out and have to make it all over again, be thoughtful about how you're allocating your assets to the marketplace. So, if any of you guys, if anybody would like to discuss any of the math or the logic used in creating this presentation, let me know. We're glad to share it with you. Marissa, real quickly before we go to the last topic, any questions that have popped up?
None submitted so far.
Great. Okay. So last week, we spent a full session on the geopolitical dynamics which confront us today. And it was an uncomfortable webinar, I think. It's always uncomfortable thinking about fat tail events on the negative side. And I think it's appropriate to let us take a few minutes to discuss what might change under a new administration. And keep in mind that everything at this point is mixed with a reasonable degree of speculation. We know what's being said, but we also know that most of the things being said are not going to come true, at least not in the time frame that they've said it. We've tried our best to sort through the unlikely objectives and discuss some of the topics that you will not hear, from the talking heads on TV and in the press. And for this, I'm going to turn it back over to Matt with my first question. So Matt, what are it feels like the world is bifurcating. There are lots of things going on that say that there are people that are siding with the US. There are people that are siding against the US and on the China side. And I hate to make it US-China, but it kind of feels like that. What are the movements taking place that seem to be bifurcating the world as we know it today? And are they real, or are they likely to continue? Can you talk about that for a little bit?
Yeah, of course. I think, well, let me just breeze over the immediate concerns. We spent a lot of time on this last time, so I don't want to talk about it too much, but the immediate concerns, I think, at the top of mind for everybody, just the dominant headlines of the two hot conflicts, one between Russia and Ukraine and one between Israel and the terror organizations to its north and east. There's been murmurs. I mean, there was a ceasefire deal that was violated with Israel and Hezbollah. But there's been murmurs on both fronts that there's, a peace deal was starting to become a possibility, or it's being talked about or taken more seriously than it has been previously. And I think back to the incoming administration, again, we don't know, but they've made strong statements that both conflicts will be resolved, or maybe not resolved, but lessened or just simmered down. I think if both of those conflicts are resolved or something close to it in the next 3 months or so, give or take, I think that's a positive indicator that the global temperature may be dropping a bit. But all of that really has nothing to do with the premise of your question, which is kind of a global bifurcation. This has been happening for years, mostly behind the scenes. Although if you pay attention to it and look at it, it's pretty apparent. I think regardless of what happens, there's a fight for global supremacy between the US and China. And I think it's going to escalate. Like I said, it's kind of been in the background for a while, for at least 5 or 6 years minimum. And I know the hot topic there is Taiwan and the reunification of China and Taiwan. That's been directly called upon and I think, there's basically a plan in place to do it within this new administration. Focusing less on that and more on just bifurcation. I think, similar to Cold War between the United States and Russia, there's going to be, a sort of picking of sides. And what that does is it shifts everything around. And two significant things is just resources will become scarce. Economies and trade deals will shift. Diplomatic relations will shift. But there's going to be, I believe, a competition for allies between the US and China. And like I said, similar to the Cold War between Russia and the United States, we wrote a paper about this several years ago, talking about China's One Belt, One Road initiative. And that really is it hasn't been talked about much. I haven't seen anything on it recently, but it's very much still in act. And that is their way of building infrastructure. They have all kinds of tactics for doing it. But relating it back to the Cold War, just to draw the imagery, one of the quotes from that piece that we wrote was, the United States and the Soviet Union spent decades recruiting countries to their respective sides, in several cases resulting in military conflict. Soviet Cold War was all about ideology, communism versus democracy. That theme is still prevalent. I mean, China is a communist country, but it's no longer the dominating factor. China has learned from the failings of the Cold War with Russia and the United States, Soviet Union, the United States, thus has avoided focusing their efforts on spreading ideology. Instead, they have focused their initiatives toward more objective forms of recruitment, using a combination of financial, political, and infrastructural leverage.
Yeah, that's true.
That's very much going on, from predatory loan practices. So China comes in and they loan money to the government of Djibouti or Ethiopia to build a port at terms that they will never be able to pay, and then they seize the port. And now that is a Chinese port. They do it all over the world. They've done it in South America, in East Africa, West Africa,
It's brilliant.
Central Asia. It's happening everywhere.
It's brilliant.
And whether that country now wants to side with the United States, whether because of relations, previous relations, or ideological similarities, cultural similarities, they think it's in their best interest. It's not an option anymore, because China owns their 3 largest ports and can cripple their economy overnight. The U.S. ultimately won the Cold War because our team was better than their team, not just because we were, we had a mightier military or any of the. Both those things were true. We had a stronger economy, better military, but really it came down to our team was better than their team. And the U.S. and China will engage in accelerated influence campaigns globally to try and recruit new allies and partners, or solidify standing relationships. Currency, natural resources, technology components, energy, technology itself, especially AI, will be divvied up and competed for. And we'll see kind of a restructuring of all those markets over an extended period of time as this kind of process takes shape. It could be important in the next few years to take more consideration of supply chains, where factors of production are coming from, and where the production itself is taking place. And I don't think it would be necessarily wrong to assume that globally economies will look to bring production closer to home. And I think the realist theory of international relations is that the country will do what serves itself and its citizens first and foremost every time. I think the world, especially the Western world, has kind of veered away from that. The United States is like the rich uncle that just throws money at everybody to make them like us. And Western Europe has been very irresponsible. Their production has dropped and their social spending has increased. I think it's possible that we may see somewhat of a reversal there. And I think, generally speaking, the United States still leads the world. And, the incoming administration has indicated that it's going to be our interests first. And we won't be the kind of global charitable organization that we've evolved into. And I think when we do that, other people, one, will try and get on our team, and also, they'll look at their own country's self-interest more closely as well. China has never really gone down that road. So they may have a head start on us because they've, like we've said, they've been doing this for years. They've already begun this process. We've historically done it for decades, but I think we've slipped a little bit in recent years. In the last 15 to 20 years, it's just, we've gotten less focused on that. And I think it's possible that we'll see a refocus there.
Matt, one of the things, I think you're describing what we've been talking about as mercantilism for the better part of your explanation there, and which means sort of reshoring, and the reason I bring that up is that means that we're going to be sourcing products and goods from our own country if that's possible. And that means they're going to be more expensive. We've lived off cheap Chinese imports for 25 years. We've helped China develop its own economy. We've taken everything that they've wanted to kick out of their country, and that's okay. I think we just didn't follow through with it and become friendly with them as this took place, or maybe that's just not their nature to become friendly. I don't know. I hope somehow in my heart of hearts that we could talk to all of the BRICS, the other nations that are sort of siding up with China, and have a conversation that came up to why can't we be friends and work together and make things better rather than going to war, which could be disastrous, literally disastrous. While you were talking, so first of all, thanks for that explanation. And while you were talking, I had a question that came in from one of our good friends here over the course, I think it was on Wednesday or Thursday. And it's a question I hear come up often, and it's basically why, despite all the things going on that are uncertain and expensive, why does the market keep going up? And I know he will. It's a he, and he will hear us. And I think the answer is, I've spent a fair amount of time, probably 10 hours over the last couple of days, trying to figure out what were the variables that helped keep things going up. And I don't want to bore you with this, but here's what I found. So we all know that there's been almost $7 trillion of new money input to the system over the course of the last 15 years. And over the last 2 years, there's been sort of 2 or 3 trillion in the form of deficit spending. That's a lot of money for a $22 trillion economy. That's, we're getting towards 10% of our economy just living off of good old Uncle Sam. The combination of that and the resilient consumer giving or offering or, buying more goods and services than they really need because they had money, created backlogs. And a lot of these companies just have been living off of their backlogs. I think that's coming to an end. I think that's one of the things that we saw in the aggregate demand charts that were the bar charts in the dark blue. It feels like that's maybe coming to an end. I'm hoping that this new administration is more thoughtful about the way they spend money. It seems like they have the bench to do it. These are smart people. These are some of America's smartest people. And they're not, it's not just Elon and Vivek. It's Elon and his cadre of friends and Vivek and his cadre of friends. And you may not like the way they communicate. You may not like the people, period. But I will tell you that these guys are incredibly successful, and they know they're business people. They understand things. So with that, I'll stop and just ask Marissa one more time just to make sure we didn't leave out any questions. Marissa, anything else on the docket, or should we just wish everybody a wonderful Christmas and New Year's, and we'll see you on January, I think it's January 4th.
Yeah, no questions submitted today, so I think it's okay to wrap this up and wish everyone well.
Okay. All right. Listen, just from me and my family to all of you all, thank you for tuning in, and onward and upward. Thanks, Matt, and we'll see you next time. Bye.